Great. Thanks for coming in.
Pleasure.
Last time we spoke about the balance sheet, and thanks a lot for your insight on that specific. We can just delve a little bit more deeper into, the balance sheet with regards to assets and liabilities. I think let's start off by, it's these fancy words you accountants use, and a lot of people get scared. The terms, if you want to put it that way, and you go, well, let's maybe start off by saying what is an asset and what is a liability. And I think more importantly, let me understand that specific thing, and then what that relates to in respect to the balance sheet.
Yeah, the usual definition for an asset will be a resource that the company acquires that'll be beneficial to the business for future economic growth or future profitability, or that'll give the company the ability to earn income.
Okay.
And that is usually the definition of an asset or a fixed asset as such. A liability will be the opposite. It will be an obligation that the company has incurred that'll cost financial resources to settle in the future.
Okay. Right.
That's the high-level definition of it.
Yeah.
An asset is something you use in your business, and a liability is something you have to pay or settle.
Yeah. So just as a, to dumb it down even further, in your normal life, and I know it's I like drawing it back to that analogy because people can understand their
personal
thing. So they got a car.
Yeah.
The car is the asset. That's what it's a tangible. There it is. It's my thing. I've got this asset, right? The liability to that asset would be the bank loan if you've got a bank loan, because you owe somebody on that specific thing. So it's what I own and what I owe to the bank.
Exactly.
Correct in saying that.
Exactly, yeah.
Yeah, and then it's just a matter of, like you said, but the only difference is, and I think this is something I have actually earned a little bit later, in my own self-development, understanding, businesses and things like that, is that in a business, a business is a juristic person. And that's very important to understand in that specific equation, especially when we get a little bit later on to owner's equity, is a lot of people think that, well, we know that in a small business, you are the business, the owner of you are the business. But in reality, while, yes, you're working in the business and you technically are the business, but in legal terms, you're not the business.
The business is its own entity on its own.
It's its own entity on its own. And we will revert back to, again, when we get to the accounting equation, because of that assets less liabilities is equal owner's equity. Yeah. So let's go a little bit more into, so yes, I just now used the example about a car being an asset. We have different type of assets in a business. Isn't that so?
Yes, that's correct. You've got assets that you define it as long-term or short-term or current assets. Your long-term assets is assets that you'll be using for more than a 12-month period. Usually fixed assets like vehicles, equipment, loans that has a longer period than 12 months before you will be able to have it repaid to yourself. A current asset is more of an asset in terms of something that will be turned around into cash within a 12-month period.
Mm-hmm. So it's very liquid, as I say.
It's liquid cash. Yeah, well, liquid or semi-liquid.
Yes.
But it needs to be tradable within a 12-month period. So that'll be debtors that's owed to you, that'll come in as you collected, inventory that you have acquired to either sell or use in the production of your income, that'll be turned around in a short time period that'll end up hopefully in the bank.
Mm-hmm.
And that's why it's a short-term or current asset.
Yeah, 100%. So something that you can trade very quickly is a current asset, and one that cannot really be traded very quickly, like you said. Is the period generally 12 months, as a norm?
Yeah, that's the norm. Okay. Because financial statements run on a 12-month basis. if you do the current year's financial statements and you list something as current, but in 12 months' time, that specific item is still on the same amount or the same value under current, it probably wasn't current on the prior year.
Yeah. Okay.
So that's always a bit of a judgment.
Mm-hmm.
Either the business owner or the professional, the accountant or the auditor who finalizes the financials need to make a decision on where does it fall in place.
Correct. Yeah. 100%. Yeah, but and when you talk about inventory as an asset, maybe just explain that a little bit more. For myself, I mean, what do we mean by inventory?
Inventory will be, if you, in the sense of, say, plumbing equipment, you buy copper piping, you buy glue or solvents or whatever you use in your business. If you buy it in bulk, not job specific, at your year end, it'll sit in your storage.
Mm-hmm.
A bunch of
whatever material
that you've bought.
Yeah.
You haven't used it.
Yes.
On any specific project yet, and that'll be considered to be inventory. Yeah. That'll be used later on.
Correct. Yeah.
So the rule is you can't expense it.
So it's not necessarily. So when we talk about cash in the bank, 100,000 rand, we can see that as an asset, as cash, because you just look at it from an auditing point of view. There is a bank balance, and it shows you 100,000 rand. But inventory, as in the copper pipe, it's not physical cash; it's a material item that's sitting in your store, and it's just a matter of then how do you accrue for that specific thing or take account for that one, because I presume you would use what you bought it for.
Inventory will be shown at cost or the lower of cost, or they call it net realizable value.
Okay.
Net realizable value will be what you're going to be able to resell it at. Now, a copper pipe will be scrap metal, will be your lowest, but your cost for buying it will be more due to the fact that you're going to be, there's manufacturing on it, there's value add.
Yeah,
you're going to use it somewhere. So that'll probably be your base where you use it from. If you can, you reuse it. If you can't reuse it, you have to show it down at scrap value or the net realizable value they're talking about.
Mm-hmm. And earlier on, you spoke about when does an asset, let's talk a long-term fixed asset, a long-term asset, when does it get written onto the balance sheet, put onto your asset value versus when you expense it?
A long-term asset like equipment, the day you buy it outright with cash, you capitalize it at cost.
Okay.
Onto the books. You start expensing it via depreciation.
Yeah.
But only when that asset is put into use. You cannot depreciate an asset if you do not use it for its intended purpose.
Okay.
If you stop using it, you stop your depreciation process as such. Tax purposes is probably a little bit of it's almost the same, but it's different because the SARS doesn't say it's depreciation. They talk about wear and tear, different sections for different assets. More or less the same thing. Write-off periods might differ from the accounting side of it. But you'll depreciate your asset once you've put it into the books, capitalized it, and you start using it. Then it'll be over its lifetime.
Okay, yeah. So I think depreciation is a topic on its own.
A
long discussion on its own. It's something that we must probably get into some of the discussion over another cup of coffee sometime.
We'll do that,
cup of tea in my case. But anyway, so the assets that you talk about on the balance sheet is what the company in net effect is worth. If you put it down, not worth.
Entirely,
Not worth. because you still have to bring the liability into the equation, but what it owns.
What it owns,
that it's, well, this is all the money that I have.
It's got control over it.
Control over it, yeah. That's a better, a good analogy from that. Then the flip side to the asset is and in our analogy of a car, I own this car, it's what I owe on that specific car. So the liability is basically what the company owes to somebody else, or what it to whoever that is from that point of view. So and I assume in the same token is that where an asset is got a current asset and a long-term asset, does the same apply on the liability side?
Yes, it does. Liabilities will be also categorized into long-term and current liabilities. Your long-term liabilities will be bank loans, shareholders' loans, usually mortgage bonds on fixed property. And then the short-term portion will be your normal trade payables or creditors, or a simpler word, and your bank overdraft, if there's any, your credit card dues, and stuff like owing VAT and probably owing tax will all lie under a current liability status. You'll have some of your long-term liabilities that has to be classified as short-term, because if you've got a 20-year bond on a property, within the next 12 months you'll have a liability payable towards the bank. That's not long-term. It's in the next 12 months.
Yes, yeah.
And you'll have a split on certain liabilities that as actually and that's usually when you've got liabilities that causes cash flow every month in the form of payments, installment payments.
Yeah.
You'll have a portion of your long-term liabilities reduced and then shown in the current liabilities portion. Yeah. Because you're going to have to pay it in the next 12 months.
Yeah.
Otherwise, you will give somebody a false idea of what your solvency is in your business, your liquidity.
Yeah.
Put it for that.
Yes.
In that state.
Yeah. So and that is, so just to get my mind right, when you talk about solvency and insolvency, that is kind of like that. It's when you look at the balance sheet and you take that into consideration, there's different equations that you use to have an eye on what the health of that company is.
The company's going concern, or to continue as a going concern.
Yeah.
Its ability to continue as a going concern. Mm-hmm. Your liquidity has got a direct impact on your current assets and your current liabilities. So if you have to take all your current assets, put it into cash,
yes,
will it be enough to cover all your current liabilities?
Yeah.
And that always needs to be positive. And then you've got a good idea of where's the company going, or the business going. Solvency has to do with your total assets over your total liabilities. Hopefully, if it's positive, you're fine, you're solvent.
Yes.
If it's negative, it means you've got trouble.
Question mark. Yeah, 100%. Because at least you can, like you said earlier on, in a liquidity issue, is that you could try and get some of your long-term assets into a liquid position to solve your liquidity issue with regards to paying your debts.
That's correct.
But if you've got no assets to make liquid, becomes a solvency problem. Then there's a question mark.
It's a different story. Then it comes down to
the shareholders putting
shareholders saving it or not,
going through that specific motion. So ultimately, if we go back to the balance sheet, so before we go back to the balance sheet, is that so we have our assets, which tells us what the company is not worth, but the
controls.
The controls, how much, well, there's the money, on for a better word, versus how much we owe to whoever we owe, and we offset those specific two. So go back again to, here's my car, and I bought it for, my car's value is 100,000 Rand. That's my asset. So we look at it on a monetary value, versus the liability, which I owe the bank, means that the I owe 80,000. So therefore my net worth is 20,000 rand.
Correct.
Correct in saying that.
That's correct.
Yeah. So this is, and we spoke about early on about the accounting equation in the balance sheet, and specifically about the fact that the owner or the company is a juristic person. Correct in saying that. So to balance the equation in the balance sheet, it's owner's equity that balances that balance sheet.
Yes.
So
it's basically the money that the business or the company, in the business, because the business can be a sole proprietor, but the company makes for its owners.
Yes.
Will be your owner's equity.
Correct. And it sits as a liability to the business because the business, as a juristic person, as an entity on its own, owes that owner that money.
That's correct.
Or wants to balance it, money from the owner to balance the equation.
If it's negative.
Yeah, and that's why it sits as a liability. That was one of those things that you had to get into your head. Well, but
how do I owe myself money?
Yes, that's right. But when I own the company.
Yeah.
Well, no, because the company is a juristic person, and therefore you need to balance it. So again, we go back to the fact that the balance sheet sits with the asset, the 100,000 rand car, right? The liability side is what I owe to the bank, which is the 80,000. That means it's not balancing at the moment because there's 20,000 rand missing. Well, not missing. We have the equation. And then how to balance it is to say, well, there's 100,000 rand lying on the asset side. The liability side is 80,000 rand to the bank, and we're left with 20,000 that needs to go to the owner as a liability, which we owe to the company owes to the owner.
Yeah,
and
therefore, in simple terms, that's how the equation will work.
Yeah, but you guys complicate it so much. It's very simple.
There's a lot.
It's you make life so difficult.
Somebody has to go study something.
Well, somebody has to earn somewhere.
So therefore, the rules keep changing.
100%. Yeah, but I think we spoke earlier on, and what you realize. I remember when I was studying, we used to sit there going, why the hell must we learn this stuff? Why must we learn this? But it's a very important part of any business.
It is.
It's about how much you want to know into it and get into it.
I think being financially literate is a very important thing for anybody, to be honest.
Yeah. No, 100%.
Your personal life, even if you don't own a business, just to have a good understanding of financial literacy.
Yeah. And it's not
for you.
It's not super duper financial. This is just basic stuff. And I think what I've come to realize is that when you look at your financial statements, it's really dumbed down to the basic stuff. It looks complicated, but it really goes down to it's just understanding a little bit. The trick will be how to use your balance sheet and your income statement and your assets and your liabilities to the best of driving your business forward.
That's it. We previously said it's like a CV that you use for people interested in your business.
Yeah, great. Yeah. Well, thanks again.
Thank you very much.
Thanks for jumping in. And I think next time we're going to jump into the income statement and have 100%. A little bit more in depth into that specific thing.
That's good.
Great. Thanks.
Thank you. Thank you, Lee.
Okay.